Critical minerals are essential to meeting the growing demand of a world in transition. Secure, responsible supply is needed to power the technologies that will transform the future, from energy transition to artificial intelligence to aerospace and defense. We are Vale Base Metals. We are stewards of industry-leading copper and nickel operations across Canada, Brazil, Indonesia, the UK, and Japan. Serving customers around the world, our purpose is clear: to provide mineral security to a world in transition. It's a role we have been responsibly fulfilling for more than 100 years. And as the world changes, we are changing too, transforming into a lean, agile, more entrepreneurial organization. Built on safety, sustainability, and trust, maximizing value by delivering reliable performance and investing in our unique growth. We're living up to our purpose and doing so responsibly and sustainably as the preferred partner for reliable, low-carbon supply. We are the new VBM.
Hello everyone, I'm James Ware, Director of Investor Relations at Vale Base Metals. Thank you all for being here and welcome to our Investor Day. As the video captured, it's an exciting time at VBM. And we hope to share this excitement with you today as the leadership team provides an update on our transformation, our achievements to date, and importantly, the growth opportunities that lie ahead. Now, please note our customary disclaimer. We'll start today with some introductory remarks from Marcelo Bacci, CFO of Vale SA. We'll then hear from members of the VBM leadership team: Sean Usmar, CEO; Tina Gauthier, Chief Commercial Officer; Alfredo Santana, Chief Operating Officer; Chris McLeave, Chief Technical Officer; Laura Brooks, Director of Sustainability; and Murilo Muller, our CFO. Following the presentation, I'll facilitate a Q&A session and give those in the room the opportunity to ask questions. With that, I'll welcome Marcelo to the stage.
Thank you, James. It's a great pleasure to be here. This is the first VBM day, and we at Vale intend this to be a recurring event, as you're going to see through the presentation that VBM is becoming more and more relevant within the Vale portfolio. So I'm very happy to be here. This is one signal of the success of this carve-out and the management team led by Sean, which is delivering incredible results and creating a lot of optionalities for us at Vale. So I'm going to share with you the perspective of Vale as a shareholder, and I'm sure I speak in the name of our partners of Manara as well, that are also very proud and happy with the results we've been achieving at the company. So VBM is a very important and a key pillar of Vale's strategy, and is becoming more and more relevant over time, as you're going to see through the presentation here. We have made a strategic decision at Vale to concentrate our portfolio in the products where we have significant competitive advantages. So we are present in iron ore, copper and nickel, and of course VBM is responsible for the copper and nickel businesses. We have a clear ambition to be the leaders in value creation in our industry, and we're going to do that through this portfolio of iron ore, copper, and nickel. We like to see Vale as a dual-engine company. We have a very strong, very robust, and consistent iron ore portfolio, where we are in a market that is huge but has low growth. We today produce between 335 to 245 million tons of iron ore. We intend to get to 360 million tons. This is a relatively stable market where supply and demand are very well balanced and with very low growth. where we have a huge presence, a huge scale, and we are cost leaders, and we intend to continue to be cost leaders and enhance our position as cost leaders in this industry. The growth comes from VBM. We like to see VBM as a fast-growing base metals business where we have a portfolio of copper, where we see a significant potential for growth, and you're going to see through the presentation of my colleagues here that we intend to reach 700,000 tons in the next 9 years, with the potential to go even further based on the reserves that we have. And we have a very strong nickel business where we can grow up to 50% of production in the coming years as well with the assets that we already have. What stands out the VBM business in our view from, I would say, the competition between the diversified players, the mining players, is the fact that we have the ability to grow organically between 4% and 6% a year in the coming years, which is a huge potential when compared to our peers. We have the ability to do that in the copper business in a region where we've been operating for more than 40 years, which is the Carajás region, where we have the people, we have the infrastructure, we have the knowledge, we have the relations, we have all the conditions to deliver this growth. And this is supported by a significant resource potential that will give us even further scalability in the future. VBM has become, over the years after the carve-out, 2 or 3 years ago, bigger and bigger in our portfolio as a result of the work that's been done by the team, the management team that will be represented here today. So back in 2024, VBM was 10% of Vale's EBITDA. This year, it's going to be, according to consensus prices, about 26%. And we have the potential to get to 30 to 35% in the long run, which is going to put the base metals business as a percentage of total EBITDA for Vale very similar to what the base metals business represent in the other diversified players, where you see between 25 and 45% representation in our diversified peers. So this is going to be very relevant. It is already very relevant, and it's going to become more and more relevant over time for Vale. And of course, one of the intentions that we have is to see this represented in the value of the company. This has been done and will continue to be done through a very important business transformation. I think this management team that we have today has been delivering an incredible review and reshaping of the operations, as you're going to see here, that will continue to generate value and create the opportunity for re-rating, especially given the growth potential that we have. We believe that we have at VBM a fit-for-purpose organization. We have an organization, we have the people, we have the resources for delivering the results that we've been delivering, and more so to deliver a fast and efficient execution of our long-term strategy. So we're very happy to be here, very proud of what these guys are achieving. And with that, I'm going to pass the floor to my friend Sean, who's been leading this for us. Thank you.
Thanks, Marcelo. Good morning. It's really good to be with you here today, to have a first of its kind, and for us to be able to share with you a little bit of our journey so far and the enthusiasm that hopefully you'll see in my colleagues as much as you'll see outside of this forum with the work that we've been doing in this business over the last 15, 16 months. So to start off, I just want to set the scene. I came to this role in October of 24, really emboldened and I think just incredibly excited about the possibility of what a carve-out represented. As someone who'd worked in this industry for a long time, to have a portfolio that really felt like it was buried under a rock somewhere, that had so much potential but really wasn't visible, and really had seen a substantial decline in performance and relevance to Vale over a sustained period of time. And to me, the opportunity at a moment where the world was waking up to its need for critical minerals in order to, as you see on our materials outside and on you saw our introductory video, to really help enable the technologies at a time as well where, from a Western perspective, we've really unconsciously been the beneficiaries of low-cost, reliable supply for so long, and that is starting to break. And we're seeing it in this moment with conflict in the Middle East and elsewhere, albeit with energy. It is having knock-on effects to a way of life which really we could not have anticipated, perhaps in crazy ways. Helium supplies, all sorts of supplies outside of energy. The same applies to critical minerals, whether it's for artificial intelligence, renewable energy, for mineral security. So here was an opportunity, a platform which is really quite unusual and completely underappreciated, vertically integrated with deep amounts of resources that have been spoken about for so long. And so for me, the grand opportunity was, how do we take this platform? How do we make sure that we can reverse that performance and change the trajectory and really create a consistent, reliable supply where we can earn the right to additional capital and growth, and to unlock that value for our owners and indeed for society? And from that point on, to be able to grow a critical minerals champion, because it's great, all of those of you who've been to mining conferences, things sound awfully generic after a while. World class, and we're going to do X, Y, and Z, but the sector has struggled to deliver to that. So it starts off with a simple plan. We have to start delivering on our quarterly performance and annual performance. This business hadn't hit guidance in a decade. We had to get that right first. Point two, we had to grow value. And you'll see the framework we've used, because we know we've got the people, we know that we have the assets and the endowment. And as we took it forward, it was make sure that we can actually unlock and unveil that growth potential. We can do so in a responsible way, and you'll see, we'll talk with enthusiasm about what that means in our social license. And then indeed, how do we rejuvenate the culture of this organization? Because I think that's the X factor. The people and the assets are broadly the same. What you're about to see is a culmination of a group of people that have found their mojo, and it's an exciting time. So you'll see over here, it's a slightly bifurcated story. Copper, everybody loves it and needs it. It's really about how do we ensure reliable production and indeed facilitate growth. We'll go into a bit of detail on that. And then in the case of copper, we've seen dramatic oversupply come out of Indonesia in particular. We already are bookended with Russia and Chinese supply, essentially. We're one of the last of the Western suppliers. We have an incredible base, a strategic base, but it has to be competitive. And the focus there, and we're still on that journey, is to make sure we get into that low half of the cost curve and unlock that potential. And then take this to the next level, because there's so much opportunity. Now, if we've done all of that, the last piece, and part of the reason we're here today, part of the reason we've published a lot of materials that you will see online, technical studies, sustainability reports, exploration and mineral reserve and resource statement updates, is really, we also then have to make sure people understand. Because it's no good if we do it and you don't have the information needed to form your own opinions as to what the intrinsic value of this business is. There's still a significant gap there. It's our job to help close that. We're going to go into more detail on this, but this is a sector, particularly just using copper as an example, that has really struggled. I think we have a sector that is atrophied, particularly in the West, for a long period of time. Skills, a lack of exploration, a lack of risk capital, and struggle to bring new supply on. A number of studies, including S&P Global, will show 50% increases in copper demand by 2040 or so, and massive deficits being projected when you look at the projects and the opportunities that are out there. I put it to you today that we're not going to make a dramatic close in that gap, but when you start looking at the growth that we are unlocking in this business, we have opportunity that is not seen in the market right now, that we can actually help improve that dynamic. And that's been the focus. How do we increase the odds in our favor? Copper last year was about a 6% deficit relative to expectations at the start of the year. That is a perennial challenge. We have to deliver consistently and we have to grow. And here's just a snapshot of the portfolio. You'll see that in the case of the polymetallic nickel business, globally diversified, nexus really in Canada, in these iconic mineral districts that are really world-class. We've been operating over 100 years, and indeed we have not just mines, but we go right through the value chain. Things governments talk about, we do, and we have done for long periods of times with smelters and refineries. And indeed, in Brazil, the nexus of our growth story in copper is on full display. Our global footprint gives us flexibility, and our nexus is in great stable jurisdictions, which I think, as we can see in this moment, is a source of real advantage. This is the framework. This isn't from a consultant, and it's not earth-shattering, but having spent time initially with our teams, we really had so much complexity in this business. And how do we then re-engage our operators? So we went back and we decentralized our business. We've got an ecosystem where we spend time with our heads of our operations and indeed in our functions, focusing on how they uniquely can understand their dominant constraints, their risks, and what they can undo to lock value and deliver more than just profit and the bottom line. We have to do that to be sustainable. We have to allocate capital while at the center, set good strategy. But operators are ultimately competing for capital and talent. And they have to really see and feel that. Growing value, if we want a decent multiple, we have to actually deliver on our projections and our results. We'll touch on that in a moment, but that's table stakes. We then have to understand how we can unlock value, and not just say we're unlocking value, but demonstrate it through action and execution. Our social license is at the center, and it's one of the challenges that the mining sector faces over and over again. The need here, we're always serving at the invitation of our host communities and our host governments. We really have to do an excellent job and make sure that that isn't something that just resides in a department somewhere, that as a team, we are far more integrated and our operators have this embedded in our life of business planning, which we've done. We have broken down silos, we've lowered the overheads dramatically in the business and really reconnected and invested more in risk. But right at the center of that is this point around people and culture. I do believe that what you will see in this organization is a rejuvenation, and that really is the key factor and the difference of what I'm certainly experiencing. We are, I think, 2 to 3 years ahead of what I thought we could do organizationally coming into this role as CEO. The level of response from the people has been really quite remarkable. This is my proud dad slide. This is last year, as you'd appreciate as a new CEO at the time coming in and expecting that it would take a long time to reverse the trajectory of capital overruns and indeed misguidance. Last year, we initiated 6 weeks in the biggest restructuring in the history of this business. We took over 400 million of cash improvements in global overhead alone, went to the decentralized model, invested in more in risk, and importantly, for the first time ever, we exceeded guidance in both copper and nickel. We lowered cost guidance in copper and nickel in Q3 and exceeded it. We'll touch on it, but part of this is also just a systematic improvement. Luck is what happens when you have 1 or 2 areas of the business that are firing. But when you see a systematic improvement and you see the teams responding, it's really quite remarkable. Importantly, with those improvements, we saw a 1.9 billion improvement in EBITDA last year compared to the prior year. 850 million or so of that was through management action. A dramatic improvement over that time, sustained dramatic improvement. And importantly, we said we cannot facilitate incredibly disruptive change and hurt our people. And we've done this at a time where we've had some of the best safety performance this business has seen. You can't have great performance without good safety performance, and that has really been a cultural shift in the group. The net result is we've got very low net debt, and we'll touch on that in a bit more detail, and a very appealing trajectory with a growth pipeline that is now self-funding and a business which is firing across the board. And just touching a bit more on some of the suite of assets and the portfolio, Salobo, our flagship, new record last year, all-time record on that business in copper and gold. 217,000 tons of copper, nearly 400,000 ounces of gold. Sossego, near the end of its life, best performance since 2021. Onça Puma, bought on under budget, allowed it with its second furnace to be able to ramp up and achieve throughput it hasn't seen. It will run this year at full capacity for the first time in its history. Ontario, with our 6 mines, we've actually hit over 5 million tons through the mill at Clarabelle. The issue there is, firstly, you have to lower fixed cost if you're going to compete competitively with, or globally with Indonesia. We've done that. We then have to increase throughput to dilute the fixed costs from mines through mills, concentrators, smelters. The unit costs and the overheads are significant in those businesses. So we've hit 5 million, we're going to go to 5.5 to 6 and then move beyond. And we're continuing to drive down costs to make Northern Ontario globally competitive. And then Voisey's. We've put billions into that area over time. Importantly, after putting nearly 3 billion in 2024 and in the years prior to that for the Voisey's Bay mine expansion, we successfully brought that in ahead of our plan on the ramp up, which gave us the ore to be able to run Long Harbour at design capacity for the first time in its 11-year history. Again, diluting fixed costs and allowing it to achieve record production. If you take away one slide, and I come back to this thematic, it's one thing to deliver guidance, it's another thing for us to optimize our life of business plans and endowments and allocate capital well. But then we have to execute. We have to also provide investors with the information needed to make sure that they can form their own opinions on whether management is full of hot air or is executing. The prior year, we were 350,000 tons. We did 382,000 tons of copper last year. We're guiding 350 to 380 because we have significant shutdowns, 110 days at Sossego later this year. But this line over here is really showing where the analyst range is. And that's not up to the analyst, that's up to us. We've got an opportunity here and you'll see the technical studies that we've got available on our website now are designed to be able to provide more of the detail so that people can actually have the information they need to fill their spreadsheets out and form their own views. That's 700,000 tons. We're going to touch on this more in the slides, but the more work we've done, and we've fully revamped the life of business planning, and we've done a fundamental change in how we go about actually working on our projects. And I'll touch on that in a moment. But that's what's at the heart of these growth rates. It is incredibly exciting. And the risk reward, given the context that the bulk of this is in Para, where we've been operating for decades, we are not at 4,000 or 5,000 meters above sea level. We have these regional plays with existing infrastructure. We have people there that are highly dedicated and working for a long time. We have an incredible opportunity to be able to, almost in a brownfields context, particularly over the first 4 or 5 years, to bring that supply online and then beyond. Like the work that we've just unveiled on our exploration drilling and beyond, that we're doing near our existing ore bodies rather than out more in stuff that may never get done or it's perhaps 20, 30 years out. We're driving MPV, we're driving optionality and higher probability of future value. You'll see that upside, and we'll touch on it in a minute. The restructure, we had a very dedicated group of people in projects, about 1,100 when I first joined, operating in silos. Not their fault. Very centralized group, a lot of complexity. We went back to first principles. We've integrated teams and removed silos because often it's one thing to do all the technical work. We have to make sure that we've looked at it very carefully from a commercial and a risk and execution point of view, and that includes licensing. We will touch on that a bit later to give you a flavor of what that means. But what it has done is it has dramatically lowered our capital intensities over this. We'll give you a bit more detail and you'll see it online. But that is a dramatic reduction. It's well below the industry average. And we've seen that many of these were already below the industry average. But we've taken Bakaba as the first one. We're in execution right now, and we'll give you some more details later. We're well advanced on this project right now. We've simplified it. We've focused on execution. The timing is well on track. And the rates of return, you'll see, have gone from mid-teens in many cases to over 50% for our first 2 projects. Even if the copper price was to dramatically reset, these are strong, robust projects that need to be executed, and we have the funding to do it. You'll see it with Alemão, and we'll touch on that in an instant, but that is incredibly exciting. Copper, gold, fundamental changes to how we've gone through execution and made it easier to license. You'll see it across the board. Exploration, we've just published, and you'll see the press release that's gone out. Chris and his team have done an incredible job with Chiara. We have even bolder targets through the drill bit in the years ahead than what we've demonstrated in that press release. In Brazil, entry year, outside of the budgets, we've stuck to our budget, but we're here to allocate capital and find our best risk and reward opportunities. We doubled drilling in Para last year. We'll double it again this year. If we could do even more, this is not a capital constraint. This is about how quickly we can get the drills to turn. And the results we're finding are incredible. Copper rich, gold rich. In Ontario, we're continuing between Ontario and Voisey's Bay with our brownfield endowment to do the same. So putting it together, the map to 700,000 tons, we will go into more detail. There is a lot more on the web. There's a lot more opportunity, I believe, beyond that horizon that we're exploring. We're not just saying, oh, how do we get to 700? We're looking beyond, and that's really where the opportunity is. How do we de-risk the execution, make sure that we deliver on our commitments, and find opportunity to go even further? And then on nickel, importantly, Sudbury, for example, synonymous with nickel, but you can see in that top right, it's polymetallic. You have to play to your advantages. We have a lot of copper, gold, PGMs. These are diversified revenue streams. I've mentioned how we are looking to lower costs, dilute fixed costs, and make sure that we can be as productive as possible to drive that business, to make sure that it is resilient regardless of what comes at us out of Indonesia or elsewhere. Strategically, we've been at this for over 100 years. We have generations. We have fathers and daughters working underground who are fourth-generation miners. This is such an underappreciated asset for Canada and indeed for the West. The same with Voisey's and Long Harbour. It is an incredible endowment, and this is an area that we're going to be spending a lot more time unlocking. We've announced, as we look to focus our efforts and our portfolio, we've announced, I think, an incredible transaction with some partners of ours over here with Exaro, with the Canada Growth Fund and Orion Mine Finance to put more money into Thompson and to ensure that we'll continue to make the most of that incredible endowment going forward. But for us, our strategy in this area is on the polymetallics, not trying to be all things to all people. And as part of that as well, we were pleased after decades of attempts to announce a framework agreement with Glencore and Sudbury. We're going to pursue that aggressively, and there may be other opportunities in the future. Not the big bang opportunities, perhaps, that might have been available 20 years ago, but indeed, let's start with this one, and we'll find more to come. That is copper-rich, and it's a great growth option for us going forward. This is the opportunity here. You've seen year on year the increase with a lot of management control, not just pricing and FX, that has driven this improvement. That's where consensus is. Our job is to make sure that consensus is narrow and indeed reflective of what we think we can do internally. It's part of why we're here, and it's part of why we're publishing information. But even here, you can see what that means as we look to continue to grow. Put a multiple on it, whatever multiple you choose, you can start getting a sense of the value potential within Vale's portfolio and more broadly. So I'm going to end there and just give you a sense as I hand over to my colleagues, which I'm really excited to give them this platform today. This business is on a different trajectory. We're delivering on our operating performance. We've fundamentally changed how we do projects. We're unlocking copper growth. We're allocating capital, I think, in a more dynamic, efficient way with the best opportunities being focused on. Our operators understand where their dominant constraints are and indeed are competing for the next in line with certain opportunities to enhance their particular areas of their businesses. And we have more work to do to continue to streamline the portfolio that we've outlined with both finalizing the transaction on Thompson. We've got the work on which we're doing with Glencore, which we look to hopefully convert in the next year. And indeed, we've got some work that we're looking to finalize later this year on Huhu, which is a really exciting copper gold opportunity. So without further ado, and importantly, we're less than 0.4 times net debt to EBITDA. We have an incredible balance sheet to enable us to do this. And at the heart of this are some of the people you're going to see today. So with that, thank you. I'll hand over to Tina.
Thank you, Sean, and thank you to all of you for coming to hear our story today. This is a critical moment for critical minerals. We're seeing a convergence of energy systems, geopolitics, and industrial policy, which is making it evident that critical minerals are moving from commodities to strategic assets. I'm going to tell you about our two main metals, copper and nickel. I'll spend a little time on the markets, the rising demand, and show you how Vale Base Metals is preferentially situated to fulfill this demand in the future. Copper growth typically tracks GDP around 2 to 3% per year. However, the electrification story is driving copper into a new phase of structural demand growth. By 2030, electricity demand from US data centers could rise from 5% of total US electricity demand today to 14%. According to a study from S&P, global electricity demand will increase by approximately 50% by 2040. Electrification is copper intensive. Copper is the backbone of electrical systems. EVs, renewable energy, and grid infrastructure all require significantly more copper than fossil-based alternatives. Electric vehicles require almost 3 times more copper than conventional cars. Increasing copper supply takes time, and supply constraints like declining ore grades and permitting and jurisdictional challenges mean copper supply cannot respond quickly. The disruption rate for copper production annually is over 5%. This means that more than 5% of expected copper supply from mines and projects each year is lost, delayed, or underperforming versus plan. Soaring demand, supply constraints, and disruption rates are reinforcing a structurally tight market for years to come. In 2025, Vale Base Metals delivered copper production at the top end of our guidance. Our long-term growth plan for copper supply from our existing assets differentiates us from our peers, as we can grow faster and at a lower capex intensity than industry greenfield copper projects. As Alfredo and Chris are going to speak more about our unique copper endowment, I'm going to focus more on our nickel production to ensure that our preferential positioning as the leading Western producer of nickel can be easily understood. On nickel, stainless steel future growth is projected to remain stable at 2.5% per year, maintaining its position as the steady driver behind nickel demand. Battery demand continues to emerge as a growth engine, with EV adoption continuing to scale globally. Global EV sales increased over 20% in 2025 and are expected to increase about 10% again in 2026. Globally, today's EV penetration sits at 23%, which means more than 1 in 5 vehicles are sold with plug-in charging capabilities. Although LFP battery technology is still gaining market share, nickel-based batteries will continue to be part of the mix due to the preference for nickel in large, premium vehicles requiring high energy density characteristics. Beyond batteries and stainless, nickel's role in superalloys and defense adds a high-value, non-substitutable demand layer, and demand in this application is also increasing. In 2025, VBM's high-quality nickel products made up almost 50% of the United States metal consumption in high-value and non-stainless steel applications. To summarize, we're seeing a 42% increase in demand for nickel over the next 10 years, including a 29% increase from the high-value market where we are a preferred supplier. On the supply side, Indonesia currently supplies 65% of the world's nickel. In 2026, we continue to see Indonesia shifting from a volume growth focus to value optimization. Policy actions, including quotas, downstream requirements, and recently a potential increase on taxation, signal a move to improving realized value across the nickel supply chain. In addition, Indonesia's sulfur imports have increased over 400% in volume in the last 4 years, as sulfuric acid is necessary to produce nickel from lateritic ores. Sulfur spot prices for Indonesia now sit at 340% over 2023 levels. The escalating sulfur and sulfuric acid costs are driving up the marginal cost of nickel production in Indonesia and are directly linked to the scalability of Indonesian HPAL production. You heard this earlier. We have mines, refineries, and smelters in several jurisdictions. So what? From a commercial perspective, customers value the fact that we can offer Class 1 nickel products from 3 separate refineries and Class 2 nickel from 2 more. We offer many nickel products for critical applications with a geographically diverse supply from 3 different continents. Our Port Colborne cobalt refinery is a 1-hour drive from many major US manufacturers. Our copper smelters in Brazil are Atlantic-facing, a short ocean voyage to the main European copper smelters. These factors allow us premium positioning with customers seeking secure supply. And as a logical result, we are the largest supplier of nickel metal into the United States from our Canadian nickel refineries. This slide has a lot going on. We've included it in the pack so you can study it later. I won't spend a lot of time here, just to say that our integrated nickel flow sheet gives us the ability to shift production between sites, optimize product margins, and maintain our nickel production performance across cycles. We can shift between intermediate production and refined products and maximize margins according to where we see value in the current market. Our end-to-end control supports consistent quality and traceability, which in turn supports our high-value customer segments. And although I've been speaking mostly about copper and nickel, we have a significant market position across several commodities. Our Canadian cobalt refineries produce greater than 50% of the cobalt metal supply in the Americas. Having multiple commodities strengthens our earnings resilience and reduces reliance on any single market. It also gives us broader relevance to strategic customers and supply chains who may want us to supply multiple critical minerals, enhancing our market positioning. As we discussed earlier, for copper, our main product is copper concentrate, which on average is 34% copper contained. We sell this concentrate to copper smelters, mainly in Europe and Canada, who then make refined copper. On the nickel side, we make finished pure nickel products, which are sold into strategic end uses. This means we have exposure to high-value, specification-driven markets. Our products are used in specialty alloys, aerospace, and batteries, where performance matters and our nickel is more difficult to substitute. We have long-term contracts, and our nickel specification is embedded in customer processes and qualification cycles with leading aerospace, automotive, and industrial OEMs. Our commercial strategy is deliberately anchored in premium performance-driven markets where material quality, reliability, and certification matter. Our customers operate in safety-critical, highly engineered applications with stringent standards that align directly with our product suite. As a result, our nickel metal products consistently attract premiums above the LME nickel price. In addition, our high-purity nickel products sit in the first quarter of carbon intensity. Low carbon isn't just a sustainability attribute for us. We believe it will become a source of differentiation in where and how we place our nickel volumes. On the right-hand side of the chart, you can see our sales footprint. We are well diversified across the Americas, Europe, and Asia, with limited concentration risk, which enhances resilience in a fragmented global landscape. As you've heard, our position as a nickel supplier is unique. We have 5 geographically diverse nickel refining facilities, and we are the only global supplier with this flexibility. We produce the largest refined nickel supply outside of Asia and Russia, and we supply our metals in a transparent manner aligned with evolving global policy and procurement frameworks and certifications, as you will hear from Laura later today. We are the largest supplier of reliable nickel metal supply to Western markets and the solution to avoiding concentrated supply risk. In summary, I'd like to leave you with these 4 points. Structural demand growth is accelerating across electrification metals. Both nickel and copper are being driven by long-term policy-backed demand, supporting a durable growth outlook. We are uniquely positioned across both metals with our integrated low-carbon platform and multi-commodity scale, enabling us to capture value. Our portfolio aligns with security of supply priorities, reliable, traceable sources of critical minerals. Diversified exposure with premium products and customers supports margin durability, reduced volatility, and long-term value creation. Nickel enables performance. Copper enables electrification, and we supply both where it matters the most. And now I'll turn it over to Alfredo, our Chief Operating Officer, to tell you a little bit more about our operations. Thank you.
Thank you. Good morning to everyone. For me, it's a real pleasure to be here today with you to share a little bit about our journey with VBM. So let me start with this simple idea of, in mining, the hardest thing is not to have one strong quarter or even one strong year. The hardest thing, in fact, is to make strong performance repeatable. And for me, this is the story of VBM today. If you look inside of our business, we simplify this in 3 pillars. Safety first, capable and stable, and reliable. Over the last few years, we focused on the basics: safety, operational discipline, technical capability, reliability, and cost efficiency. Firstly, we did a deep assessment, and we invested in the technical needs of the assets. Then we moved for a more decentralized model, driving accountability where it needs to be, and getting our decision-making faster. And why this matters? This matters because consistent and scalable performance is what creates long-term value. And our improvements are now more structural rather than occasional. And if I had to summarize our operating philosophy in one sentence, I would say that we are building a system designed to drive consistency. But let me stay with safety for a moment, because safety is where everything starts. What we are doing here is creating an operating environment where people are more alert, more focused on the potential critical incidents and fatalities. We increased a lot our risk management, and leaders are more present in the field. So when I say safety first, I do not mean safety instead of performance. I mean safety is the condition that allows sustainable performance. And I believe that solid foundation drives high performance. We have no lives lost or changed in the over 2 years now. We've cut critical process incidents by about 70%. We are keeping our high potential incidents very low. And we dropped our TRIFR from over 7 to below 2, and we are keeping this rate for the last 3 years. But more importantly, we are building the routines, the leadership behavior, the decision-making quality that make performance safer and, again, more repeatable. Now, let me look across the portfolio. You can see the result of this approach. This is not one asset performing well in isolation. This is a broad-based improvement across the portfolio. Salobo increased mill throughput by 40%, and mine movement by 13%, while we are keeping today the top electrical excavator performance in Brazil. Sossego increased truck utilization by nearly 20% and improved mill throughput by 10%. When we moved to Onça Puma, we increased plant availability by 30% and our nickel grade in ferronickel by 20%. And then moving to Ontario, Sudbury improved our ore mined by over 40%, development mine rates by over 10%, and our mill throughput by 25%. In Voisey's Bay ramped up impressively last year, and Long Harbour achieved its best result since they start up. So why this is important? Because it demonstrates that our new operating model is working. When you see improvements across different geographies, different ore bodies, different operational contexts, cultures, it tells you something very important, right? So this is not random improvements. This is systemic improvements. And that gives us the confidence that what we're seeing can be sustained. But now, let me talk a little bit about our assets. When moved to Sudbury, or to Salobo, our cornerstone copper gold mine in Brazil, ore milled increased from 25 million tons to 35 million tons in 2025, and we are going to 42 million tons by 2029 or earlier with CPF. Our critical path here is very clear. Keep boosting productivity and maintaining high focus and preventive maintenance at the plant. At the mine, with autonomous fleet, we will increase mine productivity and safety. And finally, upgrading our conveyor belt systems to over 5,000 tons per hour will raise our capacity and dilute our fixed cost. So the main point here is not only that Salobo had a good year, we're building a better asset with a best-in-class performance. Moving to Sossego now. Sossego is the foundation of our copper journey in Brazil, our first copper mine in Brazil. In 2023, we milled 11 million tons, and we are moving to 13 million tons run rate in 2026, and aiming to get to 15 million tons by 2029. We have to achieve this, we are addressing our dominant constraint with a planned 110-day SAG mill shutdown in 2026 to address critical upgrades. We have also implemented a mobile crushing system that will maintain stable production year on year. So you will not see impact of production in 2026 versus 2025, even with 30% less plant time that we're going to have this year. And when we look at Chubacaba, our next mine in the South Hub is on schedule and to begin production in 2028. So again, the message is not only that growth is coming, the message that growth is being prepared in a credible operational base. Now moving to Ourilândia do Norte in Brazil. The name of the game for Onça Puma, our powerhouse of ferronickel in Brazil, is to transition from recovery to competitiveness. We delivered 17,000 tons of ferronickel in 2023, and then 26,000 tons in 2025, and we are moving to 40,000 tons in 2026, with the 2 furnaces full operational. Our priorities there are very clear: increase the mine productivity through a better fleet use, optimize consumables, and product grade, and advance with circularity with our plant slags, and decarbonization via off-gas technology it's under implementation now. So for Onça Puma, what you see is that Onça Puma is becoming a highly competitive in a short term, and is paving its way to become the largest ferronickel producer in Brazil by 2026. Now, coming back here to Canada, where we have our polymetallic assets, we'll tell a similar story, but a different context. Sudbury is where our nickel and copper history is rooted in Canada. Sudbury has one of the most iconic mining complexes in the world, with a smelter, refineries, a handful of mines, with a very passionate people and a very proud mining community that support us there for for over 100 years of history. So there we have increased from 2023 for 4 million tons to 5 million tons of mill throughput, and we are pushing the plant to capacity this year between 5.5 to 6 million tons. Our priorities are adopting more efficient mine designs to improve productivity, shift efficiency, filling the mill, and we will reduce plant downtime by 30%. We are also aiming to lower our operating costs between 7 to 10% and improve underground development capital efficiency to up to 30% by 2028. And this is going to be, we're going to do this with a very technical way. So our goal is to lower the half, bring Sudbury to the lower half cost curve to be competitive through the cycle. Last but not least, Voisey's Bay and Long Harbor play a key role in our plan. Our goal is to reach full capacity, improve mill stability, and consistently supply Long Harbor with Voisey's Bay concentrate. Mill throughput has grown 40% in the last 3 years, and we are targeting to achieve the mill capacity in Voisey's Bay this year with 2.8 million tons per year, and with Long Harbor go above 45,000 tons of ferronickel produced. Our priority in our beautiful Newfoundland Labrador is to optimize the combination between Voisey's Bay and Long Harbor as a system. So, but let me bring this all together. The journey from 2022 to 2025 was about restoring performance and getting back to basics. 2026, we start the point to make safe, stable, capable, repeatable. And then when performance becomes repeatable, growth becomes credible. With that, I want to hand it over to Chris McCleave, who's going to present our growth platform to you. Thank you.
Thanks, Alfredo. Thanks, Alfredo, and good morning. I'm Chris McCleave, and it's my absolute pleasure to present this segment on how we're delivering growth at Vale Base Metals. What you'll hear from me this morning is not a wish list. It's a portfolio of real projects at different stages of maturity that together underpin a credible copper growth story. I want to leave you today with 3 takeaways. First, we have a clear, executable roadmap to reach 700,000 tonnes of copper. Secondly, we see credible upside beyond that level. And third, the reasons why I'm confident we can deliver. We have fundamentally changed how we work. With that framing, let me briefly explain what has changed before walking you through the portfolio. Over the last 2 years, we've fundamentally changed how we deliver growth. Our focus is margin, sequencing, capital efficiency, and technical rigour. But more importantly, we've changed the system behind those words. Since the carve-out, we have significantly strengthened our technical rigour and depth of expertise, sharpening focus across our commodities and becoming more disciplined in capital allocation. That is translating into stronger, more consistent returns. We reorganised to deploy the best base metals expertise where it creates the most value, with clear line of sight to delivery. Let me ground this in a few examples. First, Alemão. We changed the mine design to a faster ramping underground configuration, bringing forward revenue, lowering upfront capital, and reducing risk. We also improved ore body knowledge. We went back to core logging to redescribe critical geotechnical intervals at the right underground level of granularity. And we materially improved in situ stress data, adding 7 high-quality measurements in the last 12 months alone. We also looked beyond traditional project boundaries for practical upside. Geometallurgical work is ongoing to assess silver as an additional revenue stream, and options to reduce cost and improve sustainability through circularity, such as using Onça Puma slag as fly ash for backfill. Secondly, underground potential at Paulo Afonso, Secarinho, and Mata. 18 months ago, formal underground studies had not been advanced despite available information. We changed that, leveraging Canadian underground expertise to complete initial PEA level assessments, and we are now defining ways to accelerate underground exploration. Third, processing plants design. Historically, our plants or expansions have been built at capital intensities of $80 to $100 million per million tonnes per annum. Our target is now 30 to 50, aligned with copper and gold peers in the region. We've benchmarked aggressively, engaged multiple engineering houses, and redesigned 12 million tonne per annum and 24 million tonne per annum plant concepts, reducing footprints, simplifying scope, and standardising layouts. Finally, resource modelling. We re-evaluated a number of known deposits, many of which have been in our endowment for decades, but had not been revisited in any depth for many years, adding resources and improving sequencing and development options. For example, we're updating Cristalino to include satellite resources, such as Cristalino 88 and Borrachudo, and doing the same at Visconde by incorporating Emilia and Visconde Leste. Taken together, this reflects better data, better decisions, and a tighter link between geology, engineering, and execution. We then connect this foundation through three parts of the operating model. First, as Sean mentioned, an enhanced business planning process that links strategy to execution and budget, defining a clear pathway for us to reach 700,000 tonnes of copper by 2035. This process provides discipline for operations to deliver on strategy, continuous progress towards full potential beyond 700,000 kilotonnes, and consistency and predictability throughout the years, reducing uncertainty from key local stakeholders such as communities, environmental agencies, and government. Secondly, an enhanced project delivery model, fit-for-purpose design, constructability-driven engineering, and execution models aligned with risk and incentives that has delivered around 30% CapEx optimisation across the portfolio. Thirdly, disciplined exploration, focused on organic growth and endowment knowledge, delivering a 34% reduction in drilling costs over the last 2 years. And in parallel, we've also optimised our existing operations to increase value and resilience. At Salobo, we applied advanced optimisation tools, direct block scheduling, to create new phase designs that advance metal into the life of mine profile, improve early cash flow, and strengthen economics. Across the Southern Hub, we improved mineability at Secarino, reduced stripping at Mata, and advanced 118 to optimise the grade profile feeding Sossego while strengthening the licensing pathway. And in Ontario, we simplified mine extension projects, optimised mine development, and substantially reduced CapEx requirements to stay tighter in competitive, tighter nickel markets. At Voisey's Bay, we materially improved geological confidence at Reed Brook, adding 381 new drill holes since 2022, roughly a 70% increase in the geological database, de-risking the life of mine and extending resources. These examples show that our focus is not just on future growth, but on systematically improving the performance and resilience of what we already operate. And importantly, it's already showing results. These outcomes were presented earlier today by Sean and previously at Vale Day in December. So there's a consistent message here. We're achieving growth at materially lower capital intensity than before and improving project returns through better design choices, sequencing, and disciplined technical work. These results reinforce our confidence that the operating model is working, and they set the foundation for the portfolio I'll now walk you through. Our base plan is a sequenced, hub-based portfolio that supports production of 700,000 tonnes of copper by 2035, alongside 210 to 250,000 tonnes of nickel by 2030. These are deliberately sequenced, designed to build scale while managing risk, using shared processing, shared infrastructure, and staged capital. This is a fundamentally simple portfolio in technical terms. The majority of our projects are based on conventional open pit and underground mining methods, supported by well-understood processing routes. We're not relying on high-risk, first-of-a-kind infrastructure or a step-change innovation to deliver this. Also, our ambition here is not world-leading parameters or extreme assumptions. It's consistent delivery of industry-standard productivity, recovery, availability, and cost performance, executed well, repeatedly, and at scale. Alongside the base plan, we have upside potential optionality, capacity expansions, underground extensions, new ore bodies, and then technology levers, all of which are currently under study, and you'll hear more about them in the next 12 months. Now, this is a capital-intensive and integrated business. What's changed is how we deal with these risks. Today, risk is designed into our plans early, rather than after capital is committed. We test decisions up front, technically and commercially, and engage early on permitting. As you can appreciate, we're permitting multiple projects in parallel, investing early to develop more sustainable mining concepts, underground transitions, tailing strategies, and optimised processing configurations. These choices reduce risk, improve credibility with regulators, and avoid disruptive late charges. This is why the portfolio is sequenced, balanced, and hub-based. Let's now focus on Carajás copper growth. Carajás is one of the largest iron oxide copper-gold IOCG districts in the world. It is a stable, known jurisdiction where we have a long operating history, deep institutional knowledge, and established relationships with communities, regulators, and governments. This helps us engage early, plan licensing pathways more intentionally, and reduce the risk of late surprises. So when I say that this is a low-risk technical growth plan, I don't just mean from a technical perspective, but also from a geographic one, a logistical one, and a jurisdictional one. That combination is a key reason why we believe this portfolio is clearly executable. Now, let's dive a bit deeper. We'll start with Bacaba, a project already in execution, so it warrants a bit more time. Bacaba is the near-term anchor for the southern hub, consisting of a conventional open-pit mine and road access, including a bridge, for ore haulage to Sossego Mill. The construction licence is granted. Pre-stripping has started, execution is on plan with roughly 23% physical completion. Since the original feasibility end of study concept, we've reduced capital by over half without increasing operating costs. How did we do it? The first lever was simplification. We reset the project to be genuinely fit for purpose. Rather than applying a traditional one-size-fits-all internal standard, we anchored the design in Brazilian norms and industry standards using a risk-based approach informed by our own operational learnings. That alone delivered over $100 million in capital reduction, and importantly, it was done before design was locked in. The second lever was how we execute. We partnered early with an open-pit mining contractor and used that partnership to challenge our status quo. Together, we identified opportunities to reduce upfront capital, simplify construction sequencing, and improve constructability without compromising safety or performance. The third lever was mine design and sequencing. We reduced waste stripping requirements and advanced first ore. Pretty simple stuff. That directly improves early cash flow and reduces both capital and execution risk. The fourth lever was material handling. We reduced rehandling of Bacaba ore at Sossego, increasing direct feed wherever possible, lowering operational complexity and reducing both capital and operating exposure. And finally, we deliberately kept the project scope simple and tightly integrated with the Sossego existing operation, materially reducing indirect costs and overall project overhead. All these things taken together show that Bacaba is a strong proof point to demonstrate how disciplined simplification, strong partnerships, better technical decisions, and integrated execution can unlock value, while also reducing risk. Barão is next in the sequence, a high-grade, small mine opportunity that we plan to accelerate using a partnership structure, while keeping our core operations focused on major Tier 1 opportunities. Assets like 118 and Cristalino extend the southern hub even further. Again, conventional open pits leveraging shared infrastructure and processing at Sossego. We're advancing them to preserve technical and permitting flexibility so we can sequence and optimise multiple feed sources. In our upside case, we're looking into underground potential between Sossego, Mata and Secarinho pits. Recent drilling has confirmed strong vertical continuity beneath the existing open pits. We've also started exploring alternatives on how to unlock value from copper oxide ores in the southern hub deposits. This is exactly the kind of optionality that we want. Coarse particle flotation, or CPF, is a process that removes waste rock earlier in the process plant, before fine grinding, therefore using less energy grinding waste rock unnecessarily. It works by using specialised flotation cells that let copper minerals attach to air bubbles, even when the rock is still relatively coarse. By floating copper from coarser material, CPF removes about 30% of waste up front. This frees up capacity downstream in the chain so we can process more ore and produce more copper using the same equipment with less energy per unit of copper. At Salobo, CPF will increase processing capacity by about 6 million tonnes per year while reducing specific energy consumption by around 10%. Together with increased mine movement via fleet expansion and autonomous haulage operations, this generates approximately 30,000 tonnes per year of additional copper production, a great example of low capital intensity brownfield growth. We've begun early works and will bring the financial investment decision to our executive committee for approval in the next quarter. The key point, though, here for CPF is not just Salobo, it's scalability. CPF becomes a repeatable capability we can deploy across several of our concentrators over time. Alemão is a significant growth lever and an important milestone for VBM. While it has been in the project pipeline for some time, our revised technical approach has optimised the development pathway, materially reduced risk, and made the project executable. Following a focused technical review, we changed the mining method. The current scope is an underground sub-level open stoping operation with a 5.5 million tonne per annum processing plant. This shift materially reduces permitting, construction, and operating risk. The project has delivered around 500 million in capex optimisation, with study results showing roughly 80,000 tonnes of copper and 140,000 ounces of gold per year. Again, this is driven by technical rigour, not optimism. With that, we are confident to move this project forward. The project's preliminary licence was applied for in October 2025, and again, we're engaging early to de-risk. The North Hub is our next copper expansion frontier, and Palo Afonso open pit forms a base plan building block. Again, it's a conventional open pit mine and 12 million tonne per year processing plant, producing around 80,000 tonnes of copper with a potential 16-year life. There is exciting upside potential to follow, with early drilling results showing great underground potential for Palo Afonso, which we are maturing while keeping the base case disciplined. In addition, North Hub counts with other large mineral resource endowment at PGG and Furnace, which are projects that are also advancing on their maturity. Canada provides stable, capital-efficient growth with strong margins. The Victor NRSC joint venture with Glencore is a good example. The scope is synergies between the Victor ore bodies and Glencore's Nickel Rim South properties, transitioning to a 50-50 joint venture and unlocking long-life, high-grade brownfield value. At a 100% basis, study results show 50,000 tonnes per year of copper and a 20-year plus mine life, in addition to nickel, gold, platinum, and palladium content. Also in Canada, we're actively pursuing upside through mining and processing optimizations, including capacity expansion studies at Sudbury and Voisey's Bay. These initiatives build on the strong operational foundation being established, as Alfredo continues to drive consistency and reliability across the operations. Beyond Canada and Brazil, Huhu represents a compelling source of future copper growth. Huhu is currently subject to a strategic review and will be in a position to share further details once that work is complete. Another important shift has been how we approach exploration. We have deliberately refocused brownfield exploration away from generic resource growth and toward purposeful drilling with a clear business intent. That change is delivering exactly the improvements we were looking for. If we come back to Bakaba as an example, drilling to date has largely been constrained within the existing pit. We're now actively drilling the southern and southwestern extensions of the ore body. This gives us additional optionality beyond the current pit limits, pure upside. It supports better sequencing of deposits in the southern hub, the potential future use of in-pit tailings disposal, and a more optimal mine sequence over time. Another example I mentioned earlier on screen is Secarino, where we are undertaking specific targeted drilling to test underground extensions. Again, it allows us to rapidly increase geological knowledge to convert upside into executable options much earlier. Alongside this focus, we've placed strong emphasis on productivity and cost effectiveness, doing more with less. Better targeting, tighter scopes, and clearer decision criteria mean every exploration dollar works harder for the business. We've also sharpened our greenfield strategy. We're now focused primarily on Peru and Chile, where we hold highly prospective ground that remains underexplored and sits within proven copper belts. This approach ensures our exploration pipeline remains aligned with our growth ambition, feeding the portfolio with high-quality options while maintaining discipline. We cannot stand still. We must continue to innovate and improve. For us, innovation is a deliberate portfolio of technologies and partnerships that unlock capacity while improving sustainability and competitiveness. We are anchored by world-class R&D infrastructure and expertise, including Sheridan Park in Mississauga, nearly 60 years strong. We've commissioned a pilot processing plant in the Carajás, and we're proud to be the first and only carbonyl operator in the Western world. We're diligently including innovation in our plans, and we've invested over $100 million in sustaining R&D over the last 5 years. Key focus areas include copper heap leaching optimization in the Carajás, alternative feed options into the nickel supply chain, including MHP with carbonyl technology, and circularity, tailings reprocessing, low-grade heap leaching solutions, and microbiome mapping for metal recovery and bioremediation. Critically, we focus on scalability, deploying technologies across multiple assets as demonstrated by the CPF. This is how we translate endowment into more metal, stronger margins, and better sustainability outcomes over time. So, when we combine the projects you've seen today with disciplined exploration and scalable innovation layered on top of an already executable base plan, we see a robust pathway to additional production over the next decade. In that context, an aspiration beyond 700,000 tonnes of copper becomes credible. To be clear, this is not guidance, but it is technically grounded scenario thinking based on assets, infrastructure, and mineral endowment we already control. Our priority is clear: deliver the base portfolio well. Upside is there, and we will pull it forward when and where it makes sense. Let me close by returning to the 3 messages we started with. First, we have a clear and credible pathway to 700,000 tonnes of copper. Secondly, we see real upside beyond that, grounded in early results and underpinned by our endowment, our hub strategy, and scalable technology. And third, we have fundamentally changed how we work, and we are executing with discipline. We've built a system designed to deliver growth, and the early results show that that system is working to systematically grow value at Vale Base Metals. With that, I'll say thank you and hand over to Laura Brooks, who will outline how our sustainability strategy is core to our growth story. Thanks.
Thank you, Chris. Thank you, Chris. Well, today you've heard about the unique attributes of our critical minerals business. And as part of that, we've developed an approach to sustainability that ensures these minerals are produced responsibly. The approach is centered around 4 levers that you can see on the slide here. They are designed to drive mutual value, both for our business and for our stakeholders. And today I'm going to talk you through each of these levers, as well as provide some really tangible examples of how this translates into practice on the ground. So the first lever focuses on pursuing operational excellence. We've heard Alfredo talk about how he's driving the improvements across the business. And part of that is embedding sustainability into core business planning and implementation. So what does that mean in practice? And I'll share a few examples with you today from our assets in Brazil and Canada. At our Sossego mine in Brazil, the site started to experience a higher volume of complaints back in 2023. These complaints related to noise, dust, and vibration. In response, the site team set up structured engagement forums and also adapted the blasting practices directly in response to the community's concerns. This resulted in a reduced number of complaints by 60% over a 2-year period. And at the same time, the site focused on local hiring, strengthening economic ties with the region, and was able to increase local employment by 138%. So together, these types of initiatives have really helped to reinforce our social license and provide a more stable operating environment for the business. On decarbonization, we are really proud of our low carbon products. 69% of the nickel we produce and 92% of the copper we produce are in the first quartile for carbon intensity. We have reduced our Scope 1 and Scope 2 absolute emissions by 22% from the 2017 baseline. And we continue to drive the delivery of our decarbonization pathway. And not only does that help reduce emissions, we are also finding that it benefits the business by reducing costs, eliminating inefficiencies, minimizing our carbon tax exposure, and we also find that this helps to improve the workplace. So, for example, at Sudbury, we started to introduce battery electric vehicles underground, replacing diesel vehicles. This has helped to improve air quality and also noise. So it is through initiatives like these that we are able to secure our social license. The second lever focuses on enabling a growth pipeline for our business. We've heard Chris talk about the exciting opportunities that we have in front of us and the projects that we have ahead. And we're working very closely with Chris and his team and the projects on the ground in order to avoid and minimize the social and environmental impacts, respect human rights and Indigenous peoples, as well as look for opportunities to drive mutual value and positive impacts for the communities that are located close to our mines. In terms of our land-related impacts, Chris mentioned earlier that we conducted multi-factor trade-off studies and identified a preferred mining method that helped to halve the size of our tailings storage facilities and also reduce the overall project footprint by 34%. This helps to minimize our impacts on the environment in Alemão, and also it helps to de-risk the projects. We are also proud of our contributions to nature. The area is very well known for harpia eagle nesting, which is protected in Brazil. And we are working with local conservation NGOs to support educational initiatives and also work with the communities around conservation. And then finally, we mentioned community and human rights. And we are conducting human rights impact assessments in order to understand and mitigate any risks associated with the project, and also looking for opportunities to drive value. So whilst the project hasn't received its installation license yet, and the construction and early works are some months away, we are already looking for opportunities to find resourcing and skills development within the local communities so that we're ready. And it is through these types of initiatives that we are able to de-risk our project pipeline. The third lever sets out a certification pathway. We've heard Tina talking about the high quality products that we produce. Our customers expect these to be produced responsibly. And we've set out a certification roadmap designed to respond to customer interests and concerns and maintain those long-term strategic relationships, maintain our LME certificates, and also provide comfort to stakeholders on the ground that we are effectively managing our social and environmental impacts. We see our certifications as a strategic tool in order to maintain our position as a responsible producer of critical minerals. The fourth and the final lever focuses on demonstrating transparency. We see transparency again as a strategic tool to build credibility and trust with our stakeholders, meet regulatory requirements, and as well as to provide a platform for engagement with our stakeholders. We have disclosed our GISTM performance, that's the global tailing standards, and we're very proud that we are 98% conformant, and we will close those 2% of the remaining gaps by May this year. We produce an annual modern slavery report aligned with UK and Canadian legislative requirements. And last year, we produced a standalone report outlining risk and opportunities relating to nature. And today, as Sean mentioned earlier, we are really pleased to announce that we are publishing our inaugural sustainability report. This can be found on the Vale Base Metals website. So to wrap up, we've developed a value-driven approach to sustainability. It is designed to ensure that the minerals we produce are produced responsibly. And we look forward to sharing updates with you through publications and events like these in the future. And with that, I shall hand over to Murilo to talk us through the financial performance. Thank you.
Thank you, Laura. Good morning, everyone. It's a pleasure to be here. That's the final part of the presentation before we move to Q&A. So I'm going to try to be as fast as I can without losing any important content here. So I'm going to just give some colors for what we have been discussing this morning. We more than doubled our EBITDA from last year, 2024 to 2025. Part of that comes from external factors, like price, FX, but there's an important part of that, around $800 million, that comes from internal improvements that we have done along the last year. A simpler organization, we reduced our significant part of our overheads, we decentralized our operations. So all that combined represent around $500 million of that. We also have a more reliable operation. We increased production, as we have seen this morning. Salobo reached the highest production ever. We have very successful VBME ramp up, and we have Onça Puma successfully ramp up, delivering ahead of schedule with lower budgets. All that combined, in terms of volumes, $300 million. So when we add up 800 million between productivity and higher volumes. We also had to recognize the efforts in terms of CapEx, went down from 1.9 to 1.6 billion, so it's a 300 million reduction. Out of that, we believe $200 million from our controls comes also from initial significant improvements we have done through the process, organization, part of what Chris has just mentioned. Let me move quickly here in terms of all-in costs. Let me start with copper. We have been very successful in the last few years with copper. We're very well positioned in terms of the cost curve in the industry in general. There's also always areas for improvement, but we feel comfortable the way we have been operating our copper assets. Certainly in 2025, gold as a byproduct played an important part of that contribution here. When we look at our guidance for 2026, that considers gold at $3,500 per ounce. If you update that with spot prices, this guidance 1 to 1.5 would be already below zero, so it would be negative side of that. Thinking about nickel, when we look at all-in costs, also significant improvements, 24, 25, very important. But I'd like to call our attention for the way we look at what we call the polymetallic business. It's not just the costs. It's important that we also add the sustaining investment part of that. So that's really turns into cash flow positive. That's what we're looking for, that business. We see here, when we added the sustaining investment, our all-in cost in 24 was almost $25,000 per ton. With significant improvements we just mentioned along the presentation, we were able to reduce sustaining, productivity, some benefits coming from byproducts as well. That's part of the polymetallic story. So we were able to finalize the year at $17.3 per ton for nickel. That's not enough. We want to go beyond that. In August last year, we started a project, internal project, that will allow us to go beyond that and to become cash flow break-even at very low price scenarios. Not the spot price today, a scenario is a price that we considered in the past. So we're progressing with that. The plans are progressing very well. We're going to be at that stage. You're going to notice that in our results at starting of 2027. That's a medium, long-term business, right? So we don't take decisions from time to time. We need to make progress consistently, and we're doing that on those assets. Here, the polymetallic story is super important. When you look at our, again, the cost curve for the industry, we are not very well positioned in terms of the underground mining. That's where we need to make significant progress, and we're doing it. The Sudbury hub, it's an important flagship for us, and it's going to become more and more important in the future. We're looking at not only nickel, we have been operating nickel for more than 100 years. Now we are also much more focused all the other good commodities we have in the region. So copper, gold, PGMs, they represent already more than 40% of the revenues coming from some of those assets. So it's a very important story, and we're going to go beyond that. In terms of investment, we were able in the last 2 years to keep our investment CapEx below $2 billion. And we do it again this year. It's going to be around $1.6 billion. That includes sustaining and growth. When you look forward in the future and think about how we're going to grow our copper story, probably 2027 onwards, that's going to be closer to $2 billion in the average. That's what more likely to happen. As we keep seeing the growth CapEx, that's what you can see in the right-hand side of the slide in green here. That's the copper growth story for the Carajás region, year by year. As we move the next few years, we're going to reduce sustaining investment to get the cash flow break-even I just mentioned, and we're going to make more space to fund part of this growth that's coming. That's an important part. Not only that, when you talk about how we're going to fund the growth, I would like to go over that also in terms of our balance sheet. We have a very strong balance sheet. Since we were carved out from Vale, we operate our own financial strategy. We contract with commercial banks, our lines of credits, our loans. We don't rely on Vale or Manara. We have never got any additional money from them since the carve-out. So we are truly, fully sustained, self-funded business. At the end of the year, December 31st, our net debt was around $1.2 billion, which gave us a very healthy, comfortable net debt EBITDA ratio of 0.4 times. Also, an important part of that, our strategy, is we are investment grade for the trade rating agencies. So that's an important part, of course, to fund the business in terms of strategy, how we ensure to get competitive interest rates in our loans. Finally, in terms of funding the business, very important, how we create value through our cash flow generation. Last year, we worked a lot, and we're able to end up the year at a cash flow break-even position. For 2026, when you look at our plans, when you look at our forecasts, and look at what the market consensus prices are from the analysts, if we look at the more pessimistic price for each of the commodities, we are looking at cash flow generation, and that's the very last line after tax, serving the debt. So it's about something around $400 million at positive cash flow. If you take the positive, the most optimistic commodity prices from the analyst consensus, we are close to $2 billion in cash flow generation. So that gives us also lots of confidence that we're going to be successful funding the business and ensuring that the growth pipeline that's coming will be self-funded. Having said that, to finalize here, I would like just to highlight the three main topics. We'll independently of price, doesn't matter price, we'll keep focus on cost efficiency. Every dollar counts, so we're not, if prices goes up, doesn't change our discipline in terms of the way we manage costs. Secondly, capital allocation, same story. We're not gonna just decide to put money in additional investments just because we may have some additional cash or because, the market's hot and we may get accepted lower rate of returns. We're not gonna do that. We're gonna be very disciplined to just allocate capital to the proper assets. You have seen when Chris McLeave presented here, the pipeline is very impressive. So we need to fund that, and we're very confident that we can, with those projects, to get the maximum in terms of returns for us. And finally, the balance sheet. We're committed to keep our investment grade, have a very strong balance sheet in different price scenarios. We know market is very volatile. Price, they change along the cycle. We want to be well protected in our balance sheet to fund this growth. So having said that, I'm going to pass the floor back to Sean for his final remarks. Thank you.
Thank you very much. I'm going to keep my comments brief. We are a little over, and we're running into some Q&A, so give us your best shot. We've got this far without talking about artificial intelligence as a management team. What you've seen is human intelligence. Imagine the possibilities beyond. But we're going to reset the stage very quickly, and then we'll welcome all your questions. We've got about half an hour for that. Thank you.
We'll have the opportunity. Please reach out to me or a member of the Vale IR team if you've got any questions. We'd love to chat to you then. So with that, I'll ask, thank you very much. Go for it.
Hey, thanks guys. It's Chris Lefemina from Jefferies. Thanks for the presentation. So last year you delivered $800 million of productivity and efficiency improvements. You just started in October 2024, so basically right out of the gates, big upside last year. Presumably there was improvements over the course of the year. So the first question I have is, end of the year run rate, was it materially higher than that? And the second question is just, I think Alfredo talked about he showed us some of the data on productivity improvements last year, throughput improvements, which presumably were better than you expected. Is there more potential for you to deliver ahead of what you're currently guiding to in 2026, 2027? Thanks.
Yeah. Look, I think the short answer, starting with your second, is yes. We're a year ago we were sitting here talking about what might happen with tariffs and how we're going to navigate that, but it hasn't necessarily gone away. And now we're dealing with all the uncertainty of energy and logistics and that's happening I think it's going to impact the global mining sector. So for us, the focus is very much around what we can control. When we initiated the what we call Project Catalyst 6 weeks into my tenure, at that point we had a target which was about a $200 million run rate. We blew past that. And so what we found is, the more we engage the workforce, the more we engage our organization, the more we just simplified and try to focus on the things that truly drive progress and value and risk and social license in our business, the more energy and momentum that has created. You've seen the results. Like I looked at our board numbers, presented to the Vale SA board last week, and even in the August update last year, the numbers we were projecting were $600–700 million estimate for the year, worse than we achieved. So obviously we had a really good tailwind. We had a headwind with nickel, we had a tailwind with copper and so on. But in this point, there's more opportunity. We're continuing to focus on the things we can control, and we have to, particularly in the polymetallic business. Alfredo gave you a bit of a sense of it, certainly in Sudbury and elsewhere in the business. The way that we ensure we compete with whatever comes out of Indonesia and elsewhere, we have incredible ore bodies that have been around for generations. We have to secure the future through not just stuff we do in offices here, but on the ground. And I think hopefully you got a bit of a sense of that. when you go and visit our sites, and we have some site visits coming up, a site visit later this year, you start seeing with this decentralized model, operators that don't just look at their procedures. They're starting to find ways with these quarterly performance updates and then guys on the ground. They're bringing ideas to see how they know where their dominant constraints are. They understand how the Pareto of how they can add value. They're coming up with creative ideas. I think in Sossego, we saw something like a 40% unit mining cost improvement with a young industrial engineer who was just doing time and motion studies and using a rental van to get people down initially and just changing workflows. I think the more work we do, the more we will find.
Over to this one there, thank you.
Hi, Matt Murphy with BMO. Thanks for all the information today. One question on the CapEx trajectory. So you've got the copper development CapEx growing, and you mentioned reducing sustaining capital to keep overall CapEx relatively in the $2 billion range. What are the biggest sources of sustained CapEx reductions over the next 5 years?
So yeah, in terms of sustaining, as I was referring, the polymetallic is where we really are working towards a very different process of doing part of we have been progressing there. The lateral development, that's the way we call it. That's when you have to move in terms of accessing your ore bodies. We're doing it differently. We're thinking about different operation model. The way the cost when you compare with competitors, we compare with other mining companies. We are seeing that we can progress to lower cost per meter and kilometers that we would deploy. That's a significant part of that. Also, as we benefit in terms of the more we know, the more knowledge we get from some of these ore bodies, also change the way we deploy and access to those ore bodies. So significant part of that reduction is part of the program we launched last year that will allow us to reduce that without jeopardizing, of course, any of the stability of the assets, all that part that's consistent. When we benchmark, and we have been doing that a lot with our CTO team, that's an important part of that exercise as well. We can see and compare our engineering team, can look at what we have been doing mine by mine. We operate 6 different mines just in Sudbury. And even the benchmark between themselves is significant improvements coming from that, just to learn which one mine is doing different from the others. So that's lots of things that give us confidence that we're going to get a much lower sustaining in the future.
Maybe just as a follow-up, second one, the coarse particle flotation looks like a really interesting opportunity. Is the investment decision just a function of technical feasibility, or is that pretty locked down at this point?
Yeah, I'm going to bring it to the team for approval next month. So it's pretty much just the timing of our process. So we're right there. Are well above 50%. But
I think it's one where if you looked a year ago, CapEx was nearly double on that, and the pilot work and that they've done has been quite remarkable.
Great, thank you. Maybe at the front over there. Thank you.
Thank you very much for the presentation. How do you see the cost profile of Sossego as you go to Warszawa and then the other projects to feed the existing milling plant? And then when would you make a decision of going underground in Sossego? And could you anticipate that potentially, given that it's closer to the existing mill than going to 118 or some of the other satellite deposits?
yeah,
Chris, do you want to start with?
I can start
Alfredo?
answering your question. I mean, the focus across the portfolio is to drive our operation to the lower cost of the industry, right? So in Sossego it's not different. Sossego we are going to near the finishing of the existing mine that we have there. We are very focused on increasing productivity, utilization, and we are bringing the costs, we are lowering the cost as we move on. And this will also, and we are thinking of different ways to operate with partnership, etc. And a lot of benchmarking in the industry as well, like what you just mentioned. And in lowering these costs as well, we will allow, it's been actually an enabler for us to lower the project costs, etc. So yes, we are driving Sossego to a lower cost in the curve, and then this help us with the projects that we bring online. I think Chris can jump in there.
By the distance increasing, cost are coming down.
Yes.
But we,
Higher ore rates or?
there's actually lower. There are some more. Certainly, when you get
It's
into Bacaba,
basically
there's going to be all grade differences.
we did a big shift in how we operate Sossego last year. To improve this truck utilization by 20%, even with the higher distance that we have, we lowered the cost significantly, right? So this is what I'm talking about. Even with the challenge ahead of us, that we in mind, it's always like this, right? So you will get deeper and further, and you need to reinvent yourself all the time. But right now, we are really focused on getting efficiencies at where it needs to be in productivity, and that's what we're doing across the assets. And this, for me, it's one of the biggest enablers that Chris will talk about, and how we're moving projects forward faster and with more profitability, right?
If I can just supplement. First of all, Bacaba is a reasonably shallow pit. Sacarina, where the main majority of our ore comes for Sossego at the moment, quite deep. So there's a difference in terms of trade-off vertical height versus horizontal height. Cristalino, when that starts running, will transport ore to Sossego, most likely with a conveyor. And we're proving that concept up at the moment. In regards to Sacarino and the potential for underground at Sossego, it's absolutely a really exciting opportunity that we are actively drilling as much as we can to firm that up. In terms of our drilling profile, it's getting the bulk of it. So as soon as we have the geological confidence that we can turn into engineering, it'll be one of the first things we bring into the plan. But we're just not there yet to have it in the base case.
Perhaps in the middle, just there. Thank you.
Daniel McConaughey, Rossport Investments. I was going to ask you about core spark application too, but maybe I'll follow up informally. But maybe a question for Sean and maybe all of you. Sean, you mentioned earlier that things have come together about 3 years faster than you were thinking when you joined. Can you give us a bit of a summary as to why that is, what happened, what fell into place next?
Yeah, look, firstly, I'd just make one comment, for context. My last business, we looked at about 1,000 investment opportunities, and you sort of play the span from looking at debt, equity, structured finance, and so on. And one of the biggest challenges, I think, as an investor is trying to find, firstly, good geology projects which have a higher probability of being successfully executed. We're not trying to just mine the market, so to speak. And finding them in jurisdictions that, frankly, are stable. And so this portfolio as a whole, I think, is just contextually is really unusual in that regard when you start thinking about the opportunity set that's out there, and also the level of visibility that perhaps the market has, and hopefully that's come across. I think you come to every new role with a hypothesis of where you'll find it's different being recruited to, of course, being in the seat. But I think you have to have an open mind. Charlie Munger says, beware of the man of the hammer, right? You've got the cure, or you know what you're going to do. And I think early on, I rejected the Bacaba project that was put to me in week 2 because it was double the capital. We reset our approach. We got rid of most of our consultants in week 2 or 3 because we had to empower a management team to take accountability and to look at things from scratch. 3 weeks in, we got all our functional leads as well as our operating leads across the portfolio together in our technology center for 4 days. Not to lead the witness, but to listen. And that was the time where, on the one hand, firstly, I got first-hand visibility of some of what we shared today, albeit at a prior incarnation, which showed that there was more opportunity here than I'd assumed from the outside looking in. You could also see there's a level of dedication. I've got a strong view that in the West, and certainly in North America, we have failed as an industry to attract talent and to be able to build that next generation of talent. It's an underappreciated asset here. We're using young engineers from places like in Para and elsewhere, assisting in Chris's team and beyond.
there is such a depth of dedication and opportunity with people trying to show what they can achieve. And for us, walking out of that 4-day initiative, it was 6 weeks in I initiated the restructure. And part of that I could see early on was the potential was there. But the issue was there was so much complexity in this business, and it's signal to noise. If you reset and get down to how do we create value, what are the risks that ultimately we're trying to manage effectively, how do we make sure that the hardest thing very often in the sector is that you have the support and the contextual environment with your social license, and you have a team that can do this well, that framework I shared. We slashed reports, we said no to projects, we took out silos, we got rid of duplication of overhead, we broke down the information barriers between regional parts of the business, and importantly, devolved accountability as low down in the organization as possible with simplified standards. I'll ask Chris to comment on the standards and projects, for example, but the work they've done there and the integration is unreal, and a lot of the success I think we've seen is driven through that, and then to Alfredo's point, the repeatability of the assets and the culture that comes with it. But,
I think to supplement the projects teams have worked quite diligently, very hard to take our standardised, pre-standardised format from 50,000 engineering requirements, which we would put to our engineering partners to say this is how we want you to constrain yourself to build, and all of that adds cost. So taking much more industry-focused and risk-based approach, that list of requirements that we now talk to our engineering firms and partners about is less than 100. So it enables us to go from that 100 million per million tonnes per annum cost down to the 30 to 50. So it's a fundamental change to how we're doing things.
Thank you. Thanks, Chris. Yeah, the front there. Thanks.
2 questions about Sudbury. First for Tina. You've been supplying high purity nickel, low carbon intensity, extreme purity for like 100 years from a friendly country. How much are your customers actually paying for that? LME plus how much?
I'm not going to answer that question, but they are paying a premium. And I'd say the published premiums, there are published premiums. Argus, I think Fast Markets published premiums. Mm-hmm. So we're in line with published premiums. At times we're ahead of published premiums, above published premiums, and at times we're not. So yes, there's a recognition that we produce a quality product, and I believe an above market product. Sometimes the market supports us getting premiums above everybody else, and sometimes it doesn't.
Okay, thank you. And then one for Sean, Ontario and their position towards Sudbury. Because they're planning to spend $1 billion to build a road somewhere to a little nickel deposit. How much are they doing for you in Sudbury?
So you're talking about the government?
Yeah, the government of Ontario.
Look, firstly, I'd say I make a broad comment that I think both the federal and the provincial governments, it's been encouraging to see the focus on this. I think we're seeing it more broadly as a whole, and how do you streamline permitting? It's now how do we flow through into execution, and for us, it's important that it gets the headlines that you've got these greenfields opportunities that are priority projects also, but we need critical minerals now, and I think the best risk reward is the stuff in the ground that we have in brownfields, and that's really what we're focusing on. So we're actively engaging with the governments, we both here in Newfoundland, Labrador and elsewhere, but we're trying to do these things like I think we saw in Thompson. We're trying to find ways where these are win-win opportunities and where we can forge the right sorts of partnerships. We're not at a position really to sort of say if there's anything additional now. There's work, for example, on the Glencore initiative that we're doing with them. Our real focus is establishing that JV, making sure that we can actually improve, as we've done elsewhere, the economics and get to an FID as quickly as possible to unlock that. And to also make sure that people have realistic expectations on what that can be, because we've got to get that first one right. We've been very clear, you know this, that if you think about the broader nickel supply curve, look what's happening in Cuba. Australia is largely out of business. The Western supply side has really come under pressure. And for us, we've slid from the lower half of the curve over years up to the upper half. In fact, right into the fourth quartile a year or two ago. So we can't buy our way down. We have to make sure that we are doing the things that we've shared with you to get the business there, which then creates the cost structure and the productivities to attract capital and develop it. I say to our guys, like, we're part of a much longer multi-generational story. The question is, on our watch, what do we do for future generations in this minute? It's not a given. And I think it's a huge opportunity with asymmetric upside. But to your point, we have to start with ourselves and fix that before we look to partnerships or indeed with government or elsewhere. It's a self-help program.
Okay, thank you.
Yes, in the middle at the front. Thank you.
Hello, Alfonso Salazar from Scotiabank. I have two questions. The first one has to do with the Carajás and the growth opportunities. This is a region where you have been flagging all these projects for a long time. It has been, it's good to see that Cava is now moving ahead, but it has been delayed compared to your previous guidance. So just wondering what happened in the past and what makes you confident that going forward they will move, according to plan. That would be the first question. And the second is regarding the funding of all the growth that you are projecting. And probably, Bachi, this is for you, because in the past, Vale was, there was not this separation between the funding of ferrous minerals and base metals. Apparently, this is something that is more strict now. Just wondering if that is the case, and what is the strategy to fund all these projects? Thank you.
Why don't you start, Chris?
I think why do we have confidence? I think I spent a bit of time talking about our business planning process, making sure that our short-term plans are in execution, in delivery to enable long-term strategic goals. I think the way we've changed our studies teams, the way that we're engaging much earlier through the permitting process, and ultimately the base metals knowledge to actually bring these things to life. I think even beyond that, the work or the explanation that Sean gave earlier about the way that this business has changed, the way it thinks about itself, and the way that it thinks about how we can develop as a business. Being within, prior to the carve-out, being within Vale, it probably didn't have the air it needed to actually take these things through. Because when you look at them on a comparable basis, any of them probably don't have the margins or the return that an iron ore dollar produces. So now, with a very clear singular focus on base metals and copper growth, we get the ability to revisit these deposits. We get the ability to relook at how we can develop them with a lower cost of capital. All of these things enable that next step in terms of our confidence towards growing the portfolio.
I just want to compliment that cultural piece, which I know is all nice and fluffy, but again, week 2, I get pitched and told I have to approve it because it's going to Vale SA board because it's a reserve matter. I'm a 2-week-old CEO. And I said no. And I was told then it would cost us $30 or $40 million a delay to meet the next board requirement. But you could see at that point that the business had all the process in the world, but it lost sight of risk and value and how it's actually created and how it's captured. I think a lot of mining companies are not particularly good at capital allocation and actual how you think about the underlying risks and how do you get asymmetry in your favor. So to that point, you've heard about the standard changes. We've broken up the silos. We've fundamentally reset. We've looked at partnerships, not from a brand name point of view, where we say we're going to go to engineering firm X. But we've looked at I mentioned we chased away consultants for the most part. We've gone down in a surgical way to what are the capabilities that we need in these different areas to put the execution probability in our favor. So to have a situation like that, where in February last year, the board document I had then had a return on Bakaba prior to changing this thing, low teens rate of return. And that's with the tax increase in the region and so on. That is north of 60% now. With our approach, we've taken some risk capital early on to make sure that with early permitting, it was an early permitting requirements that we could do pre-strip and so on. We went on risk. So we only got our actual license on the end of January, but that allowed us, with equipment already being there, vegetation cleared, to be at 23, 24% executed right now. It's a fundamentally different approach to doing it. It's not about studies and shuffling it onto the next milestone. And I know from our Vale Day deck, my first one 2 months in, the plans that underpinned the 700 then and the opportunity to accelerate and do more now. That's the focus. I'm not particularly interested in the 700. I'm interested in how do we increase the probability of the 700, but what do we do beyond the 700? And then the only other thing is with the cost resets that we've done and the cash profile you're seeing on the business, we would have possibly been cap in hand with our shareholders. Now we are less than 1 times net debt to EBITDA. I look forward to the time going to Marcelo to say, hey, we've got more we want to invest in sooner, and we can't fund it with our facilities, but we're self-funding.
And just to add one more point that you asked about the operational idea of this, I would say that after the carve-out, we have the best of both worlds right now, because we keep very close to Vale SA in Pará with all the infrastructure built, with everything that we have there. Even greenfield projects that we have right there, it's basically the cost of a brownfield because we have everything very close to us. But at the same time, when Vale decided that we would carve out the business, it gave to us this freedom to focus in the right principles for VBM, because the principles to mine copper and nickel is not the same of iron ore. It's not the one that's better than another, it's just different, right? So, and when you have this in hand, you have the better of the both worlds together. This is an incredible, powerful thing. So if you look at how we're working today in Pará, in Brazil, we have incredible partnership. We talk together, we work with the territory with a lot more harmony right now, but with the right focus on what we need to do. So we shift a lot our where benchmark. We are benchmarking right now in the base metals industry across the world. We increase and we bring new talents to the business with the experience and background, not in iron ore, but in copper and nickel, etc. So and this is basically what is the foundation of what you're seeing happening right now that we've been doing since we carved out the business, with laser focus on efficiency, safety, and repeatability, like I said. So this, I think, when you put all this together, is the formula of this success.
Great. With that, Marcelo.
Yes, the question on funding, I think the guys here touched on the principle here. First, this company has all the ability to self-fund this growth. And they've been showing this with the improvement of their operations, and therefore with a very important cash flow generation. The company has a very low leverage today, so it has the capacity to leverage. But fundamentally, if the guys bring opportunities to grow faster and beyond the 700,000, I think I'm sure that Vale and Manara will be happy to fund if there is a mismatch between the internally generated cash flow and the needs. This is not the base case, but if the projects are good and the team is showing the capability to grow, we would be happy to fund.
All right, with that, we have used up our time, so maybe I'll just pass over to Sean for any final remarks.
Look, thank you. It's, I hope you got a bit of a sense of really the change in trajectory of this business in a very short period of time. I think this is perhaps the most consequential and I think exciting moment in my 35 or so year mining career. And to have a platform like this, which has momentum, which has, I think, a lot more opportunity and asymmetry from ore body potential, as well as productivity and cost improvements and functionality, which in turn unlocks more opportunity. You look at those capital intensities and others just compared to anything else in the sector, I think it's extraordinary. And as you can see, we've got to be a bit more evangelical about helping the investment community and others understand. This is not a promotional thing. You've seen us. We've just been getting on with it and making sure we can actually deliver on our commitments. That's the focus. So we have an education component. I look forward to our upcoming quarterly results to show you how we're progressing further on this journey. And indeed, we'll be doing site visits beyond that. But I'll end there. I'll thank my team. These guys are incredible. And indeed, our operators and our functional leads and teams around the globe, they've made this happen. And I think the best is yet to come. So with that, thank you very much.